had weak economic performance. Germany has had 2 years of contraction, and both France and the United Kingdom have slow growth. At the same time, core inflation remains elevated, and rate cut expectations have been pared back, although less than in the United States. Meanwhile, China's economy has been decelerating, with very low inflation and a marked decline in interest rates. In these circumstances, the US dollar has appreciated strongly and, according to some measures, has reached an all-time high. Turning to South Africa, the economy contracted in the third quarter. This is mostly due to an unusually large drop in agricultural production, which has limited implications for how we interpret the economy's underlying growth trend. For the fourth quarter, we anticipate a rebound. This will be supported by more normal agricultural production as well as strong household spending, given tailwinds including lower inflation and 2 pot pension withdrawals. We think this expected rebound in growth will close the output gap, leaving the economy to operate in line with its potential from the current quarter onwards. We expect potential growth to trend higher over the next few years. This gets growth to about 2% by 2027. Looking at the composition of output since the onset of COVID, mining and manufacturing have underperformed, with output still below pre-pandemic levels. It is only due to growth in the tertiary sector that the economy is bigger now than it was 5 years ago. Similarly, on the demand side, investment has been depressed since COVID, while household and government spending have been more resilient. As growth picks up, we expect more rebalancing with a recovery in investment as well as improvements in the primary and secondary sectors. We will be monitoring the data carefully to assess how closely the economy tracks these projections. The risks to the growth forecast are assessed as balanced. Moving to consumer prices, headline inflation averaged 4.4% last year, near the middle of our target range. Inflation slowed to 3% in December, having started the year above 5%. This was mainly due to favorable goods price developments, including food inflation reaching 15-year lows as well as lower fuel costs. Because of these transitory factors, inflation is likely to remain in the bottom half of our target range through the first half of this year. But headline inflation should revert to around 4.5% thereafter, aided by core inflation, which remains at or below the midpoint over the forecast period horizon. While our exchange rate assumptions have risen towards a weaker rand, the effects on the inflation forecast have been limited. This is mainly because other components of inflation have come in below previous projections, lowering the starting point of the forecast. Inflation expectations have also now largely aligned with our midpoint objective, according to the most recent survey. The risks to the inflation outlook are assessed to the upside. In the near term, inflation appears well contained. However, the medium-term outlook is more uncertain than usual, with material risks from external environment. Domestic factors such as administered prices are also problematic. Against this backdrop, the MPC decided to reduce the policy rate by 25 basis points with effect from the 31st of January 2025. 4 members preferred this action, while 2 supported an unchanged stance. The committee ultimately agreed that it was possible to reduce the degree of policy restrictiveness, making the stance somewhat more neutral. However, all members were concerned about the uncertain global outlook. The forecast sees rates drifting slightly lower over the next few years, stabilizing near 7.25%. But this rate path from the quarterly projection model remains a broad policy guide. The MPC would like to emphasize that its decisions will be made on a meeting-by-meeting basis with no forward guidance and no pre-commitment to any specific rate path. Such decisions will continue to be outlook-dependent, responsive to data developments, and sensitive to the balance of risks to the forecast. Given the challenging global environment, the MPC spent some time during this meeting reviewing a trade war scenario. This featured a universal increase of 10 percentage points in US tariffs with retaliatory measures by other countries. The scenario showed higher inflation and interest rates globally, as well as greater risk aversion in financial markets. In response, our model projected the rand depreciating to nearly 21 rand to the US dollar, with domestic inflation reaching 5% and the policy rate half a percentage point higher at its peak relative to baseline forecasts. We also looked at a scenario of accelerated structural reforms domestically. This showed growth picking up gradually, getting to 3% in 2027. Importantly, this scenario also showed lower inflation and lower interest rates in South Africa, demonstrating how structural reforms can reduce the country's risk premium and create more monetary policy space. Considering the difficulties of the external environment, it remains crucial to sustain domestic reform momentum while protecting macroeconomic stability. The MPC's main contribution is to deliver low and stable inflation with well-anchored inflation expectations. The committee remains vigilant and ready to calibrate policy as needed. Additional measures that would improve economic conditions include reaching a prudent public debt level, further repairing and strengthening network industries, lowering administered price inflation, and keeping real wage growth in line with productivity gains. That concludes our statement, and at this stage we would invite members of the media to pose any questions that you might have, and we would deal with them accordingly. As usual, please identify yourself and the media house that you are affiliated with, and we would then address your questions. Okay, everything is as expected.
Good afternoon, Governor and Deputy Governors. Happy New Year. I guess my first question is, for the members who chose to hold, what is the reasoning when we look at how low inflation has been in South Africa to date? Are there concerns? Is it a preemptive move? Would it be something preemptive, or would it be, or is there a bigger concern in the underlying inflation number, or at least domestically, that we are not seeing perhaps? And then secondly, in your trade war scenario, you highlight high rand depreciation, but that inflation remains range bound, so rising up to 5%, but that's still in your target band. So why would the policy rate rise in an instance like that? Thank you.
Good afternoon, Governor and the panel members. My name is Ntando Tsukwana from Bloomberg News. Governor, looking at your models and the fact that the repo rate now is close to the forecast for the repurchase rate for the year, is that suggestive that we are nearing a hold or an adjustment in the rate path? Thank you very much.
Okay. Kopano, yes, inflation is low. Outcome of two things: policy decisions of the past and positive supply shocks. The two positive supply shocks were the exchange rate and the oil price. If you look at what had happened since, we have had 4 consecutive months now of rising petrol price. And at some stage, the negative inflation that we had seen in the fuel price will get out of the system. The currency had also has been weaker, as we had said, that even our starting point is now weaker than at the previous meeting, mainly driven by global factors. The dollar had strengthened across most currencies. And that's why we kept on emphasizing that the risks that we had identified in previous meetings are indeed materializing. And then you say there were members who had argued for a hold, and was that preemptive? Well, you could argue that the fact that the MPC decided to cut rates was being preemptive. But that is not the game we play. Our approach to monetary policy is risk-based. And what was unanimous in the committee was that the global environment is uncertain, risks abound, and that we should continue to move with caution. And that is what almost all central banks are faced with at the moment. There is a lot of caution. So preemptive is not the kinds of things we do. We take a decision based on the outlook. And you said inflation was low, as I had said, correct, but that is in the past. What will inflation be in the future? That is what we focus on. The scenario that we talked about of a what we characterized as a trade war scenario, you say that why would the rate rise if inflation remains within the target? This is how models work. Inflation is within the target precisely because the model calculated that there would have had to be a rate rise. If there wasn't a rate rise in that scenario, then inflation wouldn't have been within target. That is what this actually then means. Ntando, are we nearing the end? Well, we'll have to define the end. Remember, in this environment, you would like to be in a position where monetary policy is neither stimulatory nor contractionary. That means the policy rate being at its neutral level. And all that we are saying is that we have gotten closer to that neutral level, and we will leave it there. Ziyanda?
Governor, we have a question from Atol Dlamini at Alliance News. It's 2 questions. What is your assessment of the 2 rate cuts since September last year? Are you seeing any changes in lending and bad loan practices? And what do you hope to achieve with this rate cutting cycle? The last question, the statement notes material risks from external environment. Can you elaborate on what these material risks are? Thank you.
Is that it from online?
That's it.
Okay. Our assessing what the impact of rate cuts or rate hikes depends on the monetary policy horizon. We estimate that the transmission mechanism in South Africa, monetary policy has an effect on economic activity with a lag of between 12 and 18 months. The first rate cut took place in September. Its effects will be felt over the 12 months from September. The second rate cut took place in November. You could say similar things. And this one takes effect tomorrow. You will have to do that. So that is what you would see. What do we hope to achieve with the rate cut? To maintain price stability. And price stability for us, we are confident that we are aiming for the midpoint, and inflation will come out there, and we believe that is an inflation rate that is consistent with balanced growth in the economy. That is what we would actually do. Bear in mind that what we are seeing during the course of the current quarter is that economic growth will actually converge to potential growth, which is the speed limit of the economy, which basically means that we would have closed the output gap. So that is what we're talking about. Material risks, I thought that we had gone to town about into detail in the statement. The global environment is uncertain. The trade measures that would be taken could have an impact on global trade, would have an impact on inflation. To the extent that they have an impact on inflation, you will see the major central bank slowing or halting the pace of reducing monetary policy restrictiveness. And with that happening, global financial conditions will remain tighter for longer, and if they are tighter for longer, it has got implications for capital flows to emerging markets, and for a small open economy like South Africa, it will not just fit through the capital flows, but will also come through the exchange rate, and a combination of all of those would affect economic activity in South Africa and would affect the inflation outcomes. And as usual, we look through the shocks and respond to the second round effects of those shocks. Complication, though, becomes when you have got a multiplicity of shocks. If they've got a multiplicity of shocks, it's difficult to look through those multiplicity of shocks, and you might be forced to act earlier in order to make sure that you restore balance in the economy. Alistair.
Alistair Ball from Bloomberg, thanks for taking our questions. I've got two quick questions. Firstly, when we spoke to you in November, we asked about the inflation targeting review, and you said you're getting close to a conclusion but couldn't give us a timeline on that. I wondered if you had any more clarity on where that review stood, if it's finished now and with the Finance Ministry, or if the working groups are still working on it. And secondly, could you characterize the concerns of the two MPC members who favored holding rates steady? What were their worries? Thank you.
I thought I'd spelled the worries. The global economy is uncertain. That is what everybody all agreed on. The global environment is uncertain. Risks abound. We have seen the risks beginning to materialize, and the question was, can we still provide a further reduction in the restrictiveness of monetary policy, or are we okay where we are? In debating and discussing these things, we are also cognizant of the things, as we highlighted, that globally there is a risk that central banks might not just halt the process of reducing the restrictiveness. They might actually go in the opposite direction. And when that happens, it adds to volatility, and we would like to avoid that volatility in the South African market too. Timeline on the discussion. The discussions are still taking place. We will have a very interesting conference on inflation targeting in March, which will help South Africans to understand the nature of the conversations in this environment, and hopefully we will share that with all of you. Good. Thank you very much. Clearly everybody has rested, and that had given them comfort not to ask too many questions. Thank you very much. That concludes the proceedings of today, and we shall see you in March.